Sparsh, with that, let's kick off the session. Thank you for agreeing to be on this. We're obviously excited to partner with you and your business to offer an investment opportunity through the Grip platform. The idea of the session is to always give an opportunity to our users to have a direct interaction with the founder, understand the business, get to ask their questions, and then help them make a investment decision. Would love for you to start a little bit about your own background. I believe you had also an interesting point of time where which allowed you to discover how Styleworks actually began. Would love to hear about this and your personal background.
Absolutely, Nikhil, and hi everyone. Good evening. So starting off with my story, right? So I'm a young entrepreneur. I started up, I think, when I was age 19, when I graduated from my, from my computer science graduation. In this is not Noida, no IITs or IIMs for that matter, right? You can consider it as a dropout activity only. But yes, I was a kind of solo traveler from the age of 15, and I had a lot of entrepreneurial spirit around from very early age, right? And that's where I jumped into my first startup when I was in age 20, just right after the college. And we were building in modular architecture prototypes around maybe capsule hotels. That's a concept of Japan, and try to deploy it on railway stations or fully modular pieces and stuff around it. But those products were 80 to 100% modular, but we realized that the market timing for them might not be good at this point of time in India. And that's where I learned about market fit products and how does timing matters into a business. And you can call it the first learning or the first failure. And I was 21, 20 and 22. And, we had to take a break. And that's where we were in 2016, when co-working spaces globally has touched in, post $1 billion mark. In the Western markets, it was rising in like anything. In the Indian and APAC markets, it was still nascent. We had around 300, 400 co-working spaces in 2016. And we could envision that, this is going to be a hotter market in the coming 3-4 years, where the supply and demand for co-working spaces would rise up drastically in India and the attached Eastern markets. And that's where I envisioned to, build up this aggregation model. That could be an asset-light model through which, when the supply demand would be at the peak, we would have already built up the technology to cater to its needs, right? And it has happened with every industry, be it the food tech industry or cab industry or hotel aggregation industry. The demand and supply both rising up, giving in the demand to aggregation, and that's what the early stage point was. And it's been 5 years into the business for Stylework. And that has been an incredible journey since the beginning. A lot of perseverance, a lot of grit into the entire young years, like couple of years when co-working spaces were fairly new in India. But yes, as the concept built its demand, and with corporates, and it's just not startups or freelancers, with corporates, big companies, MNCs, blue chip companies. We would tend to build in more and more better products around the aggregation system. And then COVID happened, which gave a kind of boom to this entire industry into a altogether different fashion, where hybrid working, hub and spoke, agile working, flexible working, everything, all of these concepts came up in an exponential rising fashion. And that's where we pivoted our model, and we came onto a B2B marketplace SaaS platform, how we can solve one for these companies and solve out these detailed flexible memberships for their spreaded workforce. So yeah, that's been my story, and that's been the story of Stylework in a brief. But yes, happy to go through the presentation and walk you through the entire thing about Stylework.
Sure. Thanks, Parsh. Maybe just to break a couple of easy confusions to happen, right? When you would typically hear of a co-working space, you would just of a provider, you would say, okay, they run an office space with desks, and they're a competitor to a WeWork or a CoWorks. That's not what you are. You are in fact, those are in one way your clients or the supply that you're aggregating, and you have a completely asset-light software only business.
Yes.
We've referred to you as the Airbnb or the no broker of CoWorks, and that's how we see it internally. But why don't you break that down for us first and explain to us what the business is very simply?
Absolutely. Let me also screen share it so that, correct. So like you rightly said, Nikhil, primarily we are not into the operator business. If, let's say, I would relate it to, if WeWork can be related to Taj or Lee Meridian into the hotel industry, we could be related to Airbnb or Make My Trip or Booking.com. For that matter, where we are already, where we are only aggregating these co-working spaces across the country. Another confusion that might comes in, what kind of spaces are these that we are aggregating? Are these also private offices which have spaces, or these are only running co-working centers? So we are only aggregating running co-working centers and managed offices, right? We have not scaled up under the model where we want to, move it from a Make My Trip model to an Airbnb model. We are on to the journey of it. So we only aggregate that because the supply in India is around 5,000 centers, running co-working centers already, and that's massive. So we believe that, focusing on that niche is important, and rather not, going in different directions. So yeah, that's the fundamental part of it. And as you can see on the slide, I'll start on with the problem solution statement that we are trying to solve in here at a broader level, right? So for companies in the post-COVID era, they are looking to avail hybrid and flexible memberships for their enormous workforces. It could be 20%, 30%, or 40% of their workforce, but that makes a considerable amount of requirement that they're looking in for at the and there's no advanced marketplace SaaS tool through which this can be done, wherein multi-city co-working space requirements could be fulfilled, or hybrid or flex walk to work or hub and spoke memberships inside these co-working spaces could be prevailed. So that's what we're trying to solve in. I'll jump onto the product slide before I come back to other market slides. So just give it a familiarity of what the product is and what we are trying to do in here. So we call it the corporate product suite. So apart from the discovery of co-working spaces, this corporate admin panel, come B2B employee application, SaaS marketplace, is designed for admin heads and facility heads of bigger companies. Let's say Times Group is one of our clients, which is having across 50,000 employees or 70,000 employees in the country. Now they're using approximately 10,000 to 15,000 seats in co-working. That's 20 to 30% of their workforce, but still considerable amount of workforce. Now they have requirements in 30 cities or 40 cities. These are tier 1 cities, tier 2s, tier 3s as well. Somewhere they need 40 seats, somewhere 100 seats, somewhere 50 seats, somewhere 60 seats. So that's what they can avail from the marketplace platform through one single agreement, one single payment solution. So we are centralizing into the decentralized workforce area, right? We are giving them unified agreement and payment solutions from the SaaS marketplace, post which we are opening the flexibilities on different scale. How we are doing that? Let's say Times Group would need a 50-seater office in Mumbai in WeWork. So they can pick it up from our platform, but later on, they can also add up more than 50 employees to that particular membership. That is up to 80 employees or 100 employees. They can also set up rosters that gives real power to hybrid working. That is half of the employees 3 days, Monday, Wednesday, Fridays, half of the employees Tuesday, Thursdays, maybe, so that the average usage is only 50 in the week. And there is a check-in mechanism that happens through the entire technology that gives exact visibility to the admin heads, to the space partners, to the employees, that how many extra check-ins are happening post 50. Those extra check-ins are calculated at the end of the month and billed as per the day pass price. So it kind of become a minimum guarantee model plus a pay-per-use model that optimizes a lot of cost for these companies, right? So our pitch remains simple to these companies that if you're using 5,000 seats across India, through our model, through hybrid optimization, you would only be paying 3,000 for 3,000 seats or 3,500 seats. The area billing added up maximum 3,700 seats. That gives you a saving of 1,000 to 1,200 seats. That's approximately $3 to $5 million on an annual cost saving on an annual basis, right? Post that, we have minimum guarantee of visits model or hub and spoke models. Let's say 20% of the workforce of these companies are permanently working from home, but they're having a lot of mental health fatigue issues where they need access to go maybe 1 day in a week or 2 days in a week to their nearest co-working space. And they want their companies to kind of reimburse that or, kind of manage that. But for a company to give this kind of membership access to 1,000 employees or 2,000 employees manually, it's just impossible because there are different categories of brands and different cities. But through the technology, this could be easily done. The admins can primarily avail 3 lakh rupees or 5 lakh rupees of recharge, create different permutation and combinations of these multi-locational memberships, different accesses like gold category in the Western region in tier 2 cities. This could be one access, silver category, Southern region, only tier 1 cities. This could be one access. And they could allot this to different categories of employees, and they could use that. So that's about the product.
Very interesting. So, I mean, I think the biggest advantage of co-working is flexibility, is the
Yeah.
ability to be flexible with your workforce. And that's what you're creating, not just in terms of discovery of supply, but
Yeah.
actually the usage of supply and then the monitoring of it.
Yes. Yes, again.
Understood. Could you've referred to a couple of client names, but I think it's very interesting because a lot of people associate co-working with startups, right? And
Correct.
that
Correct.
seems to be the clientele. But actually, the way you describe the solution,
Yes.
it's more powerful for larger corporates. Could you give
Yeah.
us a sense of both supply and demand that you typically see?
Absolutely, Nikhil, and I think very good question around this, because it's a myth and how we perceive it, that generally it's startups and freelancers who 90% use co-working, but that's not the reality. 80% of the co-working is used by corporates today, right? It as a concept came in for freelancers and startups in the world, but then it became much popular into the corporate sector. Wherein it's just for a corporate, because inside design of a co-working space, it all looks like a private office only with some common areas. The private cabins and everything is all it looks like a private office. It's just that it is managed and some open areas. In terms of clients, like for our top clients would be Times of India, Flipkart, Schneider, OLX Autos, even HDFC Bank. Like that's a non-IT sector or a non-unicorn sector that's also using massively co-working spaces. So across, but the adaptation journey has been there in the last 4 years. Like it started up with grown-up startups, wherein like companies like Flipkart or Snapdeal or OLX or Ola, and these companies were the first ones to use it massively. But then it came to IT companies, then it came to other sectors, FMCG, aviation, banking, NBFCs, and everybody almost. I don't know any industry that is not using co-working today. So that's the reality, right? So in terms of supply, I'll also show you. So we work across with 4 category of brands: platinum, gold, silver, and standard. So platinum ones are like WeWorks or the executive centers, or any luxury brand that is available. The gold ones are like AWFIS, Innovate, or SmartWorks, these kind of brands. Then silver ones are regional brands, which are having 5 centers or 7 centers, a little lower in luxury, like ABL or Spring House in the north, EFC in the west. In Bangalore, it would be Novel Spaces or Ethic Workspace and stuff like that. And then there are silver brands, standard brands, which are not known for names, but they are having 1 center or 2 centers with 50 seats, 100 seats. A lot of them are present in tier 2, tier 3 cities, and even in tier 1 cities. So we cater to all 4 categories, and all 4 have their different propositions and different TGs, which they particularly cater to. And on the right, you can see a mix of a lot of different industries, which are already a clients and using co-working space at a mass level.
It's great to see some of those logos. So congratulations. I see you have nearly 200 transacting B2B customers and some of the largest logos in the space. So that's fantastic to see. And maybe I'm jumping the gun here, but how do you typically contract with these companies? Is it a long-term contract? Is it seat specific? How does that model work?
So there are different modes of contracting with these companies, Nikhil. Like we do tripartite contracts, we do direct contracts, we do subleasing contracts, and even then there are master agreements. Like the master agreements is the purest form of full centralization that works through the panel. Like you as a company will do one contract with B, and all of your requirements, be long-term or short-term, their contracting would be handled by me at the back end with the suppliers. You don't have to get into it. But there could be, when you're transacting on a deal-to-deal basis, like one transaction, if you need 100 seats in one co-working space, then it could either be a direct contract as well between you and the supplier. Some of the bigger brands, and when we are acquiring in customers, are immediately not comfortable getting into a management contract, right? So that's a journey to take them along that way. That's why direct also comes into the picture. That is followed by tripartite, where there is one contract where all three are parties. The subscription money comes to us, and then we further pay it off to the our suppliers. And then there are sublease contracts as well, which are different part of the contracts, and that's how it functions.
I think I want to definitely talk about market size, and I will come to it in a minute. But just continuing the current thread of conversation, if you can give a flavor for what's the sort of business trajectory been in the last few years. I know you've seen almost 2.5 times growth just in the last 12 odd months in business. But if you would give a sense of scale and that growth as well, please.
No, absolutely. So I'll start with where we are today, Nikhil, and then I'll start off the trajectory around it. So like right now, we're running around at 5.5 to 6 crore of monthly GMV with these 200 plus active corporates transacting through us. In terms of supply, we have around 2,200 plus co-working centers across 100 plus cities, basically covering in every corner of India where a co-working space could exist. That comprises to around 22 million plus square feet of inventory with 440,000 inventory of seats. In terms of available inventory, it would be 2 lakh seats at a 35% availability that keeps on rotating. Total brands which we are empowering and giving business to is 250 plus. With an average of 8 centers. That's how we have around 2,200 plus centers. This is approximately 50 to 55% of the total supply of India today. That's 5,000 centers in total. In terms of, when we talk about the last 5 years growth, like 1920 was the first year when we had a $1 million GMV, and we had substantial growth. Post which, during the COVID period, despite of 5 months into the lockdown, we had around $1.7 million of GMV. FY 21-22 is where we witnessed approximately a 3x growth with a $4.4 million GMV that we achieved in last financial year, 34 crores. And this year we're already on the track to achieve $10 to $12 million of GMV, approximately 80 to 100 crores, out of which 45 to 50 crores is already set in the first 7 to 8 months. We ran on approximately around 18% of the net revenues. So just to get a flavor of it, like last year, we closed around 6.5 to 7 crores of net revenue. And this year, we'll be closing around 15 to 18 crores of net revenue to move upon the journey. And next year, we'll be looking for $35 million of GMV, close to 250 crores. And that's the growth we are looking in for this business. Okay.
Understood. That's a fairly healthy net revenue number combined with a fairly good growth rate. If you could also spend a minute or a couple of minutes on profitability and unit economics from that perspective, given that you're asset light and SaaS product, I'm assuming a lot of that operating leverage comes very early in your business. I would love to hear your thoughts.
No, definitely, Nikhil. So as you can see, on the slide, our CSC, our unit economics works on per seat basis. So one seat is a unit economic for us, and our cost of acquisition per seat is around INR 4,800. When we look at it from a B2B angle. And a long-term value in terms of the net revenue that we get out of one seat is INR 16,200. So our LTV to CAC ratio is 3 to 4 is to 1, somewhere in that range, right? So that gives a very good flavor of, staying on profitability. Although since we are an equity-based organization and we are raising in capital, we have to grow faster at a 3x, 4x speed every year. That's where we stay very close to break even. That is within 10 to 15% range of the break even, not allowing that to cross that and continuing the 3x to 4x growth year on year. We keep achieving in profitabilities on like FY 19-20 was 40 lakh of net profitability. January to March quarters are generally high profitable for us because there are a lot of lease renewals and a lot of subscription renewals that happens during that period for us. But yes, like last year when we raised the last round, we were approximately at 40 lakh of operational cost, 35 to 40 lakh. Now we are at a 1 crore operational cost in total, and the net revenues are close to 90 lakhs. So the net burn doesn't cross 8 to 10 lakhs, even we're growing at a 2x to 3x speed year on year. So that's the economics, Nikhil.
Understood. Okay. Especially I'm going to allow you to just go back to where you wanted to start with at the market size. So love to hear how you think about the market and how it's growing.
Absolutely, Nikhil. And I think that's the most important piece of it. So right now it's a $1.5 billion transacting market. And from the capitalization perspective, it's $5 billion. It is subjected to grow to almost 8 to 10x in the next 4 to 5 years. Like we're anticipating to somewhere touch around 12 to $15 billion from a transaction value perspective, and 40 to $50 billion from an entire capitalization perspective on this industry. Why that is happening is this number primarily, as you're seeing on the bottom, this number was 2% of the entire commercial real estate before COVID. It moved to 8% in FY 2021. In 21-22 end, it moved to 12%. We're surprised to see in the last 9 months, this number has moved up to 20%. So now 1/5 of the entire commercial real estate market in India is picked up by flexible co-working spaces and managed offices. And this number is subjected to go to around 30, 35, 40% in the next 5 years, picking up approximately 35 to 40% of the entire commercial real estate. The growth drivers for this industry are international operators coming in, domestic operators expanding in big time, and then a lot of developers themselves converting into co-working operators. There are in total 5,000 centers that will go up to 20,000 centers in the next 3 to 4 years. Creating a lot of supply, and obviously supply is coming because the demand is enormous. So yeah, those are the numbers in terms of moving in to the transaction perception or the transaction breakup. When we see the total transactions, the total sales that is happening in all of the co-working spaces today in India, 39% of it is being sold by manual brokers. 56% is sold by their own sales team, and tech aggregators, since we are pioneering it at the moment. So we have picked up 5%. This number was before 2 years, less than 1%, right? So we've reached 5%. So in the next 3 years, what we are seeing is the tech aggregators will pick up 45%, and operators, sales team will only sell 35%, and manual brokers as 27%. This trajectory we have seen in multiple, like in hotel aggregation and other aggregation systems growing in faster. In terms of inside this 5%, like we are holding around 20% of market share with maximum transactions that we are doing within the competitive landscape. Like our Qdesk or MyHQ, a couple of competitors for us are doing around 17% and 12%. Remaining 43%, 8% are from other 8, 9 smaller aggregators that are into the market. So we wish to grow this 20% to 50% and continue as a market leader in terms of inside the tech aggregator space. When you see the growth opportunity for us on a 3-layer basis, one is growing the market share from inside the tech aggregator bubble from 20% to 50%, a 2.5x growth multiple. Then increasing the tech aggregation sales out of the total sales from 5% to 45%. That's a 9x growth multiple. And then the industry in itself is growing from $5 billion to $50 billion, almost a 8 to 10x multiple. That's where we see a 200x plus growth possibilities if we expand it faster. And that's what is a golden opportunity to kind of crack in this market.
Got it. I mean, I can once again, given how we think about our workforce, and now Grip is about a 70-member team split across 5 or 6 cities. I think the reality is that our business and most businesses are thinking of a hybrid working space. Yes. And in that situation, there's no option but to look at co-working. Maybe just talking about competition, because I know that's something that most of our users think about. While you have, and congratulations on being the largest operator in the space. But as you think about the differentiation between some of your competitors, what are some of the things that you think will stand out?
So Nikhil, very simple, right? The B2B corporate product suite technology is our key differentiator, right? There are other aggregators which are just running on discovery platform, right? Or on a B2C basis. Like when you talk about the close competitions that like MyHQ or Qdesk in India, they are both being acquired by JLL India and Anarock India. So we are the only non-acquired brand who are scaling it up with the right traction. And if you talk about MyHQ, they're more focused on the B2C frontier. They also have like cafes on board and dealing with freelancers and startups, all 10 to 20% B2B. But our focus is 80% B2B and the B2B CPS technology. Qdesk, on that matter, focus on B2B, but they don't have a technology product to scale around it. They're doing B2B on a manual basis, right? We figured it out very early, right? The discovery platform or B2C is not the bigger disruption in this industry. How you can solve in for a company of 50,000 employees, or 10,000 employees, or 1,000 employees. I think that's the bigger picture around the technology that we wanted to solve. And that's what we have built in level 1, level 2, level 3 of CPS, Corporate Product Suite. And that's what differentiates us. There are other features from the technology standpoint, like virtual tours or 3D floor mapping, a Redbus kind of a feature, or real-time availability integration that nobody in the globe has done in this industry. We're already at 20 to 25% of it. Within the next 6 to 9 months, we'll be the only aggregator globally with having across 90% of inventories integrated to be transacted on a real-time basis, be it long terms or short terms, within the flex tech aggregator marketplace. So I think these are the key differentiators. But this is Indian landscape. Like apart from my HQ and Curious who are being acquired and a little closer in terms of revenue, not the product, there are 6, 7 smaller aggregators which have emerged in the last 1 year, but they are on pre-seed round or seed round, and their traction, reach, and everything is way behind than where we are today. In terms of the US landscape, so we have a US counterpart who has also entered the Indian market, a Flex, and the kind of round that we are raising right now, they closed in 9 months back. Why India? Because India is the second fastest growing market. Again, this brings in more validation to us, but also an opportunity, so that across the globe, there is no big unicorn or a $1 billion startup sitting in the space. The US one is also at Series A and not that far away, right? So their technology and our technology competes on S2S basis, and that's healthy for the market. And that's where we're looking in for a global opportunity scale.
Yeah, and I think that was going to be my question. You speak about, and even in the beginning of this introduction, you talked about not just the India market, but the Asia market as an opportunity. How do you think about scaling, and is that part of the fundraise objective?
Yes, absolutely. So I'll come on to so we have 4 nodals that we have divided our expansion into. Obviously, India, post this fundraise Series A that we're raising right now, remains as the majority focus, like 80% focus for us, as the opportunity is huge to increase our market share here itself. But yes, next 2 nodals would be Southeast Asia and Middle East, where we have already our advisors and our channel partner discussions going in for the last 6 months. Will be launched. Middle East is already kind of launched up, and Southeast Asia will be launched up next quarter. Those are the two areas where we want to test our international SOPs and international expansion frontiers. Good markets, but comparatively smaller markets. And so because we don't want to dilute from our India focus at the moment before we get into Series B. Once Series B is into place, we'd like to also expand to UK and US and the APAC markets, the upper part of the APAC market in Australia as well, slowly and steadily till Series C. For that, we have a channel partnership strategy, and also that brings in a strategic investment strategy or an M&A strategy to the brand, like bigger IPCs for that matter, like CBRE Global, which have a presence in 190 plus countries, having maximum mandated clients, and are getting enormous demand for flexible workspace through their clients. Need a technology partner like us, either through an M&A mode or a strategic investment mode. So yes, we also received some kind of acquisitions offers in the past, but we don't want to sell the brand right now. But maybe at the Series C or Series D or a partial 26% kind of a thing. So that array is open, how we can expand faster on a global scale. So we will not have to go region by region. We'll just have to crack in the channel partnership and grow the brand accordingly.
Understood. Sparsh, maybe last question from my side before I open it for the Q&A from people listening in.
Yes.
You could talk a little bit about the fundraise that you're doing, who the lead investors are, what's the valuation that you're raising at?
Absolutely, Nikhil. And I would like to start in with the background of the fundraise. I think we've done a couple of rounds in the past. First was seed round that we did in 2019. We raised around 1 crore at a $1 million valuation. In 2021, last year, we raised around half a $1 million at a $5 million valuation, led by Inflection Point Ventures, our Ventures, WFC, and other marquee HNIs. In the last couple of years, we also got these names on the advisory board and from across the globe. like somebody from Silicon Valley, ex WhatsApp or Google founding member as the technology advisor and investor. To Anil Gupta, who is also a principal advisor and investor, was ex-president Reliance Infrastructure, General Electric and Honeywell, worldwide marketing head, and these kind of people working with us very closely. Right now, we're raising in Series A. That's a $3 million round, valued at around 18.1 million pre-money, 150 crore, out of which we have around 2.1 million already committed in. We're looking in for last 900K, close to 6.5 crores. The incoming investors in this round are APJ Family Office Group, QI Ventures, We Founder Circle Reinvesting, Succeed VC, Welfare Investments, and some of the marquee operators, smaller gold size operators who are coming in on a personal capacity in this fund. So yeah, that's what the commitment size and that's what the round is. Okay.
Understood. And I just want to let everyone know that we've obviously opened this as an investment opportunity on the Grip platform. Feel free to see this video. It will be shared on the platform, but also more information about the business that you can read and then reach out to us for any questions. Perfect. I'm going to, there's a question that I'll start with, which is from Rajesh about pricing plans. And maybe you could give a flavor about it and also talk about, the specific question is around what is the unit of per visit in terms of time. Maybe you could just give us some flavor to that.
Absolutely, Nikhil. So in terms of pricing, see, per seat per month price varies between 5,000 to 25 to 30,000 INR. And I think for the platinum ones are between 18 to 25,000 plus. The gold ones are between 12 to 18,000. The silver ones are between 7 to 12,000, and the standard ones are between 4 to 7,000. That's the pricing breakup. In terms of day visits prices, we standardize them. Like for standard category, we charge 250 rupees. For silver category, we charge 350 rupees per day per visit. 500 is for gold and 750 is for platinum. And in terms of on the time angle, like day visits are counted as a full day visit, right? Like we do not go for 1 hour, 2 hours, 4 hour kind of visit, but that could be done for meeting room and conference rooms. Meeting room and conference room time economics works on an hourly basis. But when you are using open desk or dedicated desk or private cabins, it minimum works on a daily basis. And we haven't got requirements from the B2B front for on a half-day basis kind of requirements for day visits. So meeting room, conference room, yes, that is even to the granularist half hour as well.
Understood. The next question, Sparsh, is actually, I think, very topical because we're seeing a lot of digital companies deal with cyber risk, cybersecurity issues, especially when they deal with client and information. So you're clearly a very product-focused, technology-focused company. How do you think about managing some of that risk that you have around client information, and what are some of the things that you put in place?
Absolutely. So there are two angles of it. One is about the security at the space, and one is about the data that we are getting as a technology-based aggregator. In terms of the security at the space, physical or digital, right? Cybersecurity or anything like that, or separate firewalls or separate Wi-Fi's and etc. All of that. Co-working industry and the operator have evolved themselves in the last 3 to 4 years to cater to these demands to some of the most cybersecurity sensitive companies across the India, right? Whatever they need in terms of customization from different firewalls to different security checks, these operators are capable of doing that. When we do the handholding, we further focus on where we help these companies to kind of further negotiate with operators to kind of get more advanced cybersecurities at these places when they're taking on a long-term basis. In terms of the data security and privacy on our platform, we are very much concerned about it. So whatever data we are intaking from their HRMS or the data that is going to space partner application, whatever integrations are there, every checkpoint is well versed with the data security and privacy concerns, so that the data is not misused, and we keep a very solid control over it. Nikhil.
Understood. Moving to the next question. As you think about the revenue model and the commercial arrangements, is there a revenue share that you have to pay to the co-working space? Like you're billing your clients and you pay a revenue share to them, or is there a different model that comes into place?
No, so I think, yes, I'd like to go on to that slide to answer this. I think our business model remains to take commissions from co-working spaces for what business we give to them, right? If a client is giving us 20 lakh of business and that is going to an operator, 10 to 18%, like 2 to 3.6 lakh rupees is what we'll be getting in from the co-working space operator. So we do not charge any commissions from clients. So that's how it functions. And post which, like from clients, we charge in SaaS revenue, right? Since it's a SaaS-based marketplace, so there is a freemium version. If you just want to use freemium version for transacting co-working spaces, we do not charge any SaaS money from the clients. You can come in there and just transact short-term and long-term memberships. But if you want hybrid memberships or rosters or consolidated billings, different admin settings, workspace dashboard, analytics, optimization metrics, reports, and ETCs, then there are payable versions on the SaaS, like 60,000 or 1,20,000 for an annual basis for up to 500 employees, or you can pay quarterly or monthly as well. So that's how it's a two-sided revenue focus, right? One, we charge revenues or commissions from co-working spaces on transactions. Second, as we grow the usability on the product for these clients, we charge in SaaS revenue. That's why our net revenues as an average have moved up to 18%, because the transactional commission average is 12 to 14%. Added up with SaaS revenues and other ancillary revenue streams that are coming in place due to the network effect of the marketplace, it's giving a total flavor of net revenue average to 18%.
Understood. Very helpful, and maybe deep diving into that a little bit. What percentage of your clients, or what percentage of your revenue comes from the top 10 clients, and what percentage of clients are on a SaaS revenue? If you could give a sense of that.
Absolutely. So I think from top 10 clients, we get around 45% of revenue. And remaining 50 clients, we get another 30%. And remaining 30% we get in from other 100 plus clients, 120 plus clients. So that's the breakup, because for us, CAM accounts, top 10 are the CAM accounts, right? Which are transacting 2,000, 3,000, 4,000, 5,000 plus seats from us. And these are bigger MNCs. The mid ones are blue chip companies, which are not the global MNCs, but still too bigger in India with an employee strength of 40,000 to 50,000. And then the remaining ones are SMEs or smaller startups or smaller companies, which have employee strength of up to 1,000 employees or 2,000 employees, which are transacting through us.
Understood. Thank you for that. Could you give a sense of how many clients are on the SaaS revenue?
Absolutely. So correct. So there are two parts of it. If you'll ask how many clients are on the product, it would be 60% plus. If you'll ask how many are paying SaaS revenue, that'll be 30 to 35%, because we have a freemium version as well, right? And right now we're into the adaptability phase and scaling up phase. So we want the freemium version to be used more as the adaptability towards it grows more and more. Slowly we can, charge in more towards the SaaS revenue. And since it's not Zoho or Freshworks, right, where the only revenue capabilities from SaaS, the main revenue capabilities are also from transactions and the commissions inside it. That's where the economics for the SaaS marketplace, we are focusing between 30 to 60% through the product or the SaaS revenue, the traction that is coming along. CPS act as a catalyst for us for the business, where SaaS revenue can also be picked up slowly and steadily. But growing up, the ultimate focus remains growing up the maximum value of transactions and the portfolio of these clients that we are transacting through us.
Yeah. No, in fact, 30-35% paying users is a fairly healthy number early in your journey. We see much lower numbers across a lot of other businesses, especially in a B2B business. I think that will scale up fairly quickly, and I understand that there are two large revenue streams for you. Sparsh, the next question that is coming is more around client attrition, right? And I would say that I would focus that question on the clients who have taken the SaaS services or paying for SaaS services, not necessarily the transactional piece. So what percentage of SaaS clients have continuing to use the platform?
I think 70 to 80%. Somewhere you can call the average at 74, 75%, because we haven't seen more than 25% attrition over the clients who have been using SaaS. We've only seen, a lot of them uplifting it. So we have a freemium model. a freemium side of it, a pro version and an advanced version. So we have seen 30 to 35% of clients jumping in from freemium version to pro version in 6 months, and then from pro version to advanced version in next 3 to 6 months, right? So over 9 to 12 months, we have seen 70 to 75% of clients jumping over. Some of the companies have just stuck till pro. They don't want advanced, and half of them, or little less than half of them, have jumped into the advanced version as well. But yes, 20 to 25% is something that we have seen attrition, and that is the journey that along the journey we'll keep improving it.
Got it. Okay. I think these questions have prompted a lot of other questions. So I'm just going to pick them up one by one. What's the typical duration of the contract that you have with your clients? And the other questions around customer acquisition costs, which you mentioned earlier as 4,800 rupees per seat. Obviously, if I'm not stating that correctly, please go ahead and correct me.
Absolutely. So 4,800 plus seat is the CAC, and the LTV is somewhere close to 16,200. Sorry, Nikhil, I missed the first part of the question.
Typical duration of a contract with the SaaS client.
That is 1 year. That is 1 year as an average. That's why we calculate the unit economics of LTV also at a 1 year life cycle minimum. That's the average. Some are between 3 to 6 months also. Some goes up to 18 to 24 months also, but the average stands at 12 months.
Got it. Okay. As you think about the last few years, and I think you mentioned early in the call that COVID has actually been an enabler to your business because there was a change towards co-work of hybrid spaces. Yes. But as you think about potential challenges that may happen in the future, right? Key risks to the business. Would love to hear your thoughts on that.
I think first thing first, that how COVID changed, just to give everybody a perspective. COVID brought to our industry a U curve, right? And couple of 2-3 U curves after every wave that happened. Like obviously during the lockdowns, nobody could use the space. That was the initial part of the U curve, but then it moved on to the bigger part of the U when companies started coming back and they wanted co-working spaces for the 30% of the audience or 40% of the audience. Like before COVID, it was 3% in flexible workspace and 95% in commercial. After COVID, it moved to 50 to 60% still in commercial space, 20 to 30% work from home, and remaining 30%, substantial amount of it into the flex space. So A, that is what has happened to us. B, in terms of threat, the one of the threat that we see it and how we convert it into an opportunity is that bigger brokers or bigger IPCs picking up technology on this, and that could become a big competition to us. But we see it as an opportunity because those are investment and M&A routes for technology brands like us. Second, obviously, a lot of question comes that what if the COVID or the biological era does not continue? And then that can be seen as a risk, right? But we don't see that as a risk because even if the biological era does not continue, but where we have already came in so far, there's no going back. The only question is how fast this market will grow. Will it grow from $10 billion to $25 billion in next 3 years, or it will grow from $10 billion to $40 billion? In both the cases, the market is growing substantially. So again, we see it as an opportunity, not the risk. Going a little deeper into the subjective of this, if the COVID thing does not function, will these flexibility memberships will still be a need point? What we see is hybrid memberships where there are fixed memberships at a dedicated location, but they're used on a hybrid basis, are there for a longer term to stay, right? And this is as per a lot of surveys, a lot of Morgan Stanley, CBRE, Cushman, a lot of Asia Pacific reports for the next 3 to 4 years. Maybe work from anywhere or work from home will not become a much popular trend going forward, but that's what not our focus is. Our focus is fixed term memberships and hybrid memberships. So these are the risks, and that's how we have planned to mitigate the risk by keeping our focus areas to the thing that is gonna be for long in this industry.
Understood. Thanks, Parsh. One related question that's come up is that, is there a risk you see of clients going directly to co-working spaces to negotiate terms and spaces with them and seats with them?
See, multi-tenacity and trespassing is something that happens in every aggregation industry and a marketplace. But how our platform is designed basically mitigates that risk. Because what happens is that we are telling our clients that if you come through us, we will give you consolidated agreements and consolidated payment solutions, right? If you go to spaces directly, they can't give you consolidated payment because one brand won't say to other brand that let's merge the agreement and give it to them. So that creates stickiness to the clients to come on the platforms and transact through us only till the time our pricings are competitive. And that's something that every marketplace had how they play. We have management contracted rates from these operator brands. And as a second point, then we play around with our margins and our CSEs involved into the pricing mechanism and the pricing algorithms. So and at the top of it, like they can't avail hybrid or MG plus pay-per-use model when they go directly to a space. Let's say you as a client go to a space and we work and say, I need 50 seats. Can I add 100 people and give access to them? And they can use on a roster basis. The answer would be no. They're like, you can get in 50 Aadhaar card IDs and we can only allow 50 maximum. Some people coming in for guest or some for meetings, that's okay. But 100 people, not at all. So hybrid memberships and all of that could only be done through a technology. When clients see that and see the entire uses of the CPS and they get some usability and adaptability to it, and they see that pricing is also okay, that's not much of a change if you're going directly through them or going directly or through the aggregator or through a broker. They remain to stick. But yes, that couldn't be 100% in this industry. 70 to 75% is where we are today. Like 3 years before, when we did not have proper agreements and lead registration processes and all of that, and this kind of technology, the number was 30-35%, 60-65% clients were trespassing, and we couldn't track them and all of that. But now that number has moved up to 70-75%. 20-25% will still remain in this kind of in at least in the India landscape, where we're dealing with REHs and admins, but that's okay. Our focus is only 60-70%, and that's a huge market.
Yeah, no, I think that's well put. And if you were purely a discovery platform, which I believe some of your competitors are, I think that chance of trespassing remains very high. But you're a real value enabler, value addition to that journey, and you're providing versions and SKUs and services that are not available to them directly. I think one of the other points that you mentioned earlier, Sparsh, was about how the cost saving, how this actually is tangibly converting into cost savings for companies. Could you remind what that number is for a company over a year?
Absolutely. So we are somewhere saving around $2 to $3 million for a multinational if they're transacting through us. How that is, let's say we consider that a MNC with an employee strength of 30-40,000 employees in the country. And if they're using 20 to 30% of their workforce in co-working spaces, that is approximately 8 to 10,000 seats they are using on a pan-India basis for their employees through co-working spaces. Now, when they do hybrid memberships and or enable it through the flexibility model 1, that is minimum guarantee of seats plus pay-per-use model, we ask them that everywhere you reduce your minimum guarantees because you can track your pay-per-use at the top of the minimum guarantee, and you can avail this, right? So in the end, you will not end up paying for 8,000 seats, but only 6,000 seats or maximum 6,200 seats or 6,500 seats, giving you a saving of 1,500 seats or 1,000 seats. When you calculate it at a 10,000 per seat per month basis, the annual savings that comes is around $2 to $3 million, and that becomes substantial for a company or for a corporate.
Thank you. I know this has been a bit of a rapid fire to you for all directions. So last few questions. One is back to economics and profitability. Post 2024, how does, I think that's the path to get to profitability. What are some of the key drivers in your view to make that happen?
Correct. FY 23-24, we are looking in for full EBITDA profitability. The growth drivers to it is obviously SaaS revenue growing up at a massive scale, right? Till FY 23-24, and that is basically 100%. Entire SaaS revenue has 100% contributional margin. Also, the other network effect revenue streams coming along, like advertising or priority listings within the platform, or advertising inside the physical spaces, or consultancy revenue or data analytics revenue will add up a lot more to the BTL revenue streamline. And I think all of this combined in, the CAC will come down, and LTVs will grow higher with add-on revenue streams. And that's how the net EBITDA profitabilities could be easily seen in at a scaling mode as well.
Yeah, just from if I could add my 2 cents, I think from my experience, products which are SaaS based, and hence just provide more scalability for less amount of manpower, development, etc. I think is the nature of this business, and hence, as long as you get the right clients and you have a good retention ratio, which you have, I think it becomes more easier to try to strive to profitability.
Absolutely, Nikhil, and I second to that. Like, in terms of like our other competitors, which are non-technology based brokers in the market, for them the math remains simple. If you have 20 people sales team, the business will grow from like if you grow 20 to 40, business will grow from 10 to 20, right? But for us, if the sales team and the technology teams grows from 50 to 100, our business of 1 crore can grow from 1 crore to 10 crore, right? So giving is 1:5 ratio.
Yeah. Sparsh, does your platform, I think could maybe interesting, is does your platform also integrate with a company's ERP?
Yes. Yes, we integrate with ERPs and HRMS, and that's how we are deep integrated product. And we use it for cross integration as well, where we integrate, we give the plugin of our software inside the HRMS softwares. Like, and that also becomes one of our go-to-market strategy for that matter.
That's super interesting. Okay. And very sticky and powerful. Yes. Last 2 questions, very small questions. Do you have any litigations and disputes? And what's the typical credit cycle for receiving your money?
Litigation and disputes on us, no. But yes, sometimes like 5 to 10% goes into the like of the payment collection, like from goes into the legal cycles where our legal is pursuing to collect in, but that's not more than 5 to 10%. In terms of the payment cycle, in terms of commissions from the co-working spaces that comes, that the average is 30 days, because somewhere it is 7 to 15 days. As the brand grows, like the platinum brands given 45 days to 60 days as well. That's where the average is 30 days. From the corporate perspective, it works on an advanced basis. Like the monthly recurring memberships, they have to pay within 1st to 10th. And then we pay across to the co-working spaces. We hold the money for 15, 20 days to increase our cash flows. But yes, some of the big accounts, even the subscription money that is coming along on a recurring basis, it comes within 15 to 30 days, because then we get consolidated bigger payments in 30 to 45 days. So that's the distribution.
Understood. Perfect. I think I would love to label this session as a myth-breaking session. The number of myths I personally had when we started talking to you about the business, and I think people generally anyone would have about a co-working business, I think have really been shattered. And thanks to you for covering it in such detail. The fact that you are only asset light, pure SaaS platform. Secondly, the fact that it's not just discovery of seats, but actually of complete value add proposition linked into an ERP solution of a company. The fact that the market is growing so fast across commercial workspaces, and that clients are predominantly not startups, but large corporates, which are using those value-added services. And I could keep going on, but I think it's been very interesting. And thank you so much for all of your time to talk about this and to share your insights. Once again, love that we are partnering with you, and all the best for your business. Thanks to everyone who joined in. We'll be sharing a recording of this video with you over email. And you can, as I mentioned before, reach out to us for more details. Thanks so much, Sparsh.
And thank you, Nikhil, and well summarized. And thank you for the warm words as well. And we love the session and look forward to interacting more with all the users and investors, and look forward for a stronger journey forward.
Thank you so much.